you back on the call. A lot is going on, a lot to talk about, and so we're very excited about getting your thoughts and insights over the next hour.
All right, thank you very much, and thank you for inviting me back today. There's certainly a lot going on internationally and locally. It's kind of hard keeping on top of everything that's going on at the moment, but basically everything seems to have boiled down to the inflation outlook and what central banks are most likely to do. And we've seen inflation globally spike over the last year. We've seen supply chain disruptions which continue, with China going through their isolation and lockdowns. That doesn't look like it's going to change near term, so the supply chain disruptions look like they're going to persist, although we would expect some easing over the next year. And then you've got a war in Ukraine as well that we have to keep an eye on, and what that's doing to commodity prices globally. But we've seen commodity prices spike as well. So oil prices obviously a lot higher than what they once were, and we've seen quite a sharp spike in petrol prices locally and internationally. So globally, we've had these two big disruptions, and then you've had central banks and governments globally pour trillions of dollars into their economies. So with very loose monetary and fiscal policy, economies were coming out quite strong last year, and that has led to further inflation locally in many economies around the world. So inflation globally is running at about 7.5%, which is the highest it's been since 1990. And then you look at a few economies around the world, like the United States, inflation is running at 8.5%. And obviously locally, inflation is running at nearly 7%. So inflation certainly is the hot topic at the moment, the cost of living crisis, so to speak. And what do central banks do to combat that? And we're seeing central banks around the world tightening policy. So interest rate markets around the world are rising. We're seeing interest rates rise, and they're continuing to rise. We've got a lot of central bank tightening priced into markets, and we're starting to see the long end of the curve continuing to grind higher as well. So those longer end rates, the 10 to 30 year rates of curves have lifted substantially over the last month. So interest rates globally are rising. Interest rates in New Zealand have clearly risen, with our central bank being one of the first to tighten. This week actually is quite an interesting week for global financial markets and us locally. We've got the US Fed, who's making a decision on Thursday, our time, and the market is expecting a 50 basis point hike from the US Fed, taking their cash rate up. Now, that is fully priced by the market. It's been well telegraphed by the Fed, and they've got inflation running at 8.5%. It'll be interesting to see how the market reacts to their move on Thursday, but I do think it's a continual strength in the US dollar, which we've seen over the last couple of weeks. The US dollar's really strengthened quite a lot in anticipation of Fed rate rises, and the interest rate differential. So US interest rate versus an interest rate in Japan, for example, the difference between the two continues to get wider, and that's causing yen depreciation. So it's an interesting week, and we'll also hear what the Fed has to say around their balance sheet runoff. So they've built up a behemoth of a balance sheet, and it looks like they're willing to start running that down. They'll put a cap in place of around $60 billion for US Treasuries, which means that every month they can allow $60 billion worth of treasuries to evaporate effectively from their balance sheet. That's important because that's going to put upward pressure, I think, on the long end of the US curve, which will then put upward pressure on the long end of the Kiwi curve. So the US Fed's very much in focus this week. They have announced pretty much that they're going to do a 50 basis point hike. Once they deliver that, it's about how many more 50 basis point hikes do we get this year, and the market's pricing in, at least another 3. So some big moves coming in the form of US tightening. Then you look to Australia. We've got the RBA meeting tomorrow. Now, Australia's economy is a little weaker than New Zealand's. Didn't quite have the same amount of capacity pressures as New Zealand's, but they still got inflation running well above the top of their target band. So last week we saw Australian inflation spike to 5.1%, which is again the highest we've seen in Australia since the 1990s. And the trimmed mean, so their core measure of inflation spiked, and it spiked from 2.6% to 3.7%. That's a massive jump in domestically generated core inflation. So the RBA tomorrow, there's a good chance we see a hike from the RBA tomorrow. If they don't go tomorrow because of the election, or because they feel they need to wait and see wages later in the month, then we'll see a larger move, I think, from the RBA in June. They really did back themselves into a corner with their yield curve control. Basically, what they did is they targeted the 3-year point of their government bond curve, saying that they're not going to hike until 2024. And here we are with them needing to hike now. So they really did paint themselves into a corner with that yield curve control. But I do think they will change course quite quickly now that inflation's running the way that it is. And we'll see the RBA tightening, if not tomorrow, then definitely in June. So that's our, one of our largest trading partners. You've also had the Bank of Canada come out and do a 50 basis point rate hike, and you've had the Bank of England come out and continue to tighten rates as well, and they're expected to tighten further this Thursday. So the Bank of England will also come out and deliver a 25 basis point move. What I'm getting at here is that central banks around the world are facing into high inflation and they're raising rates. And the RBNZ is no different. And I do believe that the fact that the Fed this Thursday, the Bank of England a month ago, tightened 50 basis points, I do think that played into the RBNZ's hand at the last meeting as to why they tightened by 50 basis points. They knew that the others were coming. And we're expecting another 50 basis points from the RBNZ at the end of May, on the 25th of May. So we have a cash rate here in New Zealand of 1.5%, which is still considered accommodative. Neutral in New Zealand is considered to be around 2%. So with that in mind, we think the RBNZ delivers another 50 basis point move in May, on May the 25th, and takes the cash rate to 2%. Again, that's fully priced by the markets. The markets have quite an aggressive tightening track for the RBNZ, but the RBNZ has told us that they want to take the cash rate to at least 3.25%, maybe 3.5% by the end of next year. So there's still substantial tightening in the pipeline from the central bank. Now, what that's doing locally is we've seen a lot of that priced in already, and you would have seen all the banks lift their retail rates in the last couple of weeks. We're sitting here looking at a swap curve which has a 4% terminal rate priced into it, and we're taking those swap rates and we're converting those into mortgage rates. So, we've got a very high swap curve at the moment, particularly out to 3 years. So all of those mortgage rates, 1, 2, 3, 4, 5 year mortgage rates have all been hiked.
Yes, I can.
As the wholesale market has pushed higher. So
how long does it take for that to sort of flow through? Obviously, people need to refix and run off their existing mortgages, and what is, as a bank, I'm assuming that you have an understanding of how long it takes for the impact to be felt.
Yeah, it's about 9 months, which is a lot shorter than it used to be. It used to be about 18 months, because most people would fix for 2 years and not think about it. Whereas these days, people are fixed for shorter periods because we've been in a falling interest rate environment. And about 70% of New Zealand's mortgage book, the entire thing, rolls off this year. So 70% of that mortgage book is going to be refixed higher over coming months. So it's a huge amount rolling off over the next basically 6 months. So yeah, that's going to have a decent impact. Oh, sorry, what was that?
Oh, just property owners will probably get quite a surprise then when, obviously it depends when you're refixing, but people don't look at it until the moment in time that they need to look at it. And so then, that might cause a few shocks. I'm sure some are already feeling it.
Yes, I think some are definitely already feeling it, and we've seen it in the market already. But as you say, a lot of people just forget about it. They fix and forget, and then they get this reminder from the bank saying, "Oh, hey, by the way, your rate's coming up for a refix," and that's when they make the decision. They don't realise that you can actually go to the bank beforehand and refix quite a bit earlier if you want to. So yeah, no, that'll cause, I think, quite a bit of pain this year. And as a result of that, we've revised our forecast growth for New Zealand down on back of more tightening than we'd previously expected. So yes, it's going to have an impact, and we think we're going to get a big dent in consumption later in the year. We've already seen the property market turn. We expect that to continue. So we're forecasting at least a 5% decline in house prices on the back of these interest rate moves. Interest rates are that's one of the main drivers of the housing market, obviously. And interest rates going from, low to mid twos to, low to mid fives is a massive move. It's a doubling in mortgage, interest repayments. So that's going to definitely have an impact. The other thing that drives the New Zealand housing market is supply demand. The good news is that we're seeing a lot more supply coming on board, which is helping the market, and we're starting to see that in the property statistics that there's a lot more supply of dwellings coming onto the market, which is good news for those who are wanting to buy. It's not such good news for those wanting to sell. It's definitely become a buyer's market at the moment.
Aside from the property market, Jared, do you think the economy, both in New Zealand and globally, is strong enough to withstand these rate moves that we are seeing? We haven't seen anything of this magnitude really for minimum 5 years, I suppose.
Yeah, you're absolutely right, and it's going to be an interesting tightening cycle. Whether they can engineer a slowdown or whether we end up having a hard landing, it's going to be touch and go. Financial markets are flirting with the idea of recession, with inverted yield curves out and about there, particularly in forward space. Your 1 year forward rates versus the longer end are inverted in many parts of the world. So that's a signal that the market thinks that it's going to be more of a hard landing than a soft landing. But I think global growth will get 3.5-4% this year, which is still reasonably good. There's a slowdown in China, which I think will be of a concern later in the year. But the developed markets seem to be pumping out reasonable growth. If it has been revised lower, it's still reasonable growth. The Kiwi economy, we think we get around 3% growth this year, which would be a good outcome, even with the downward revisions to consumption. So we are tracking reasonably well, and we should, handle a lot of the tightening. But I do worry, this time next year, what state we're going to be in, whether things have slowed down, a lot more than what we've anticipated now.
Do you think, it's interesting you sort of made the comment next year, because obviously we're entering an election cycle at that point. Do you think that sort of brings any sort of action by there's the usual lollies at election cycle, but do we get more at that point if the economy's under stress?
If the economy's under stress, I think definitely. And does the government have capacity? Yes, they do. Have they set themselves up for a positive surprise? Yes, they have, and they'll probably try and do that again next year. So the May budget this year will see, a bit more spending and a positive surprise once again. So their revenues have exceeded forecasts, and their costs, their expenditure has come in lower than forecast. So they'll end up with a better budgetary position, and I think they'll try and do that into next year as well. So they will have some ammunition in an election year.
Policy-wise, there seems to be, at least the media is portraying it, a bit of a mismatch between how the RB is wanting to tackle things and obviously what the government's doing. How would you describe the relationship, and where both bodies are trying to take things forward?
Yeah, good point. The RB, I think, has given the government a very, silent type message that we don't need expansionary fiscal policy at this point in time. But obviously the government expansionary fiscal policy is a lot more fun and election worthy than contractionary policy. So it'll be an interesting tightrope I think Grant Robinson has to walk this year, leading into an election next year. So I think the relationship is interesting. The Reserve Bank, I think, has found themselves in a situation that they would prefer to find themselves in. The counterfactual is always there. Would you rather face a heated property market with high inflation, or would you rather face, high unemployment and an economy which is still struggling? We know how to rein in inflation. We don't know how to get ourselves out of deflation. So there's always that asymmetry in their thinking. So I think they'd much rather tackle this problem than the other sorts of problems that we may have faced. So I think they will be sitting there, ratcheting up interest rates best they can to get things down. I think they could almost say that they've done what they needed to do in terms of the housing market. And if they don't, if we wake up in a year's time and the housing market's run away again and is up 10-15%, then they'll put on DTIs, debt to income ratios. They'll talk about that this Wednesday in the Financial Stability Review. But they have signalled that they're not going to use them until next year at the earliest. And the reason why is because the housing market has turned already on the back of their LVR restrictions, the triple CFA. Those two changes have had a meaningful, a material impact on credit creation.
One of the questions that's come through in relation to, I guess it's demand for housing, and some people are saying that immigration with the borders opening is going to, skyrocket again, and there'll be a lot of people coming in, and that'll increase demand for housing. And then obviously on the other side of the coin, there's the brain drain and lots of Kiwis going abroad again. When you kind of weigh up the two there, what do you think that will do for, I guess, the economy at large, and also for with labour constraints across the board, and obviously the housing market as well?
So we get most of our migrants from China, India, South Africa. and these are countries that are not waiver visa countries, so they don't open up basically until October. So we expect to see a significant outflow of Kiwis, net outflow as of now, and over the next few months. So to start with, we're actually going to see a net negative in terms of migration flows, and quite a substantial one. We believe it's going to be about 20,000 outflow, which is quite material. We haven't seen that since the Australian mining boom. So during the Australian mining boom, obviously there was a massive pull for Kiwis to go over to Australia, earn six-figure salaries driving trucks in the mines. Now I think it's 2 years of pent-up demand to leave, this desire to do OE and get overseas. So we basically, what would have happened over a 3-year period is going to be condensed, I think, into the next 6 months. So we'll see an outflow. But then naturally, New Zealand is a very attractive place for people from China, India, and South Africa. We keep thinking of ourselves as, it's us versus Australia, or it's us versus the UK. Do we attract Australians, or do we? No, not at all. It's about how we are perceived relative to Asia, and we are still perceived to be a relatively, wealthy, attractive destination for these people. So net migration will turn positive, I think, quite quickly leading into next year, and we'll start seeing those migration flows returning, and we're forecasting a net plus 30,000 into next year. So we go from a contraction of about 20,000 to an inflow of about 30,000, which is a wild swing in migration flows into next year, and that'll then again, when you're importing more people, as I think that question highlights, you need more homes, you need more public services, etc.
Yeah. At the same time, Australia, with commodity prices going up as a result of inflation, it's entirely possible that another mining boom kicks off, right? And and perhaps there's another, in a year's time, another force that pulls the other way again.
Yeah, potentially. Yeah.
It does suggest potentially there's a little bit of an air pocket towards the back end of this year. If you've got interest rates, the impact of interest rates hitting, you've got outward migration flows, potentially sort of a real lull at the end of this year.
Yeah, exactly.
Stepping back a bit, I suppose we've been in a pretty much the last 20 years interest rates have moved lower, and we've had periods of market stress, but generally economies have been very robust, maybe not firing on all cylinders, but robust. We're facing quite a different scenario now, and there's a lot of talk last year about inflation being transitory, but are we actually moving into quite a different economic regime that we really haven't seen for sort of 10 or 20 years, do you think? Or is this just more of a temporary type event?
I think a lot of what we've seen will ultimately be classed as temporary, although it just doesn't feel like it at the time. I mean, 2 or 3 years in the scheme of things feels like forever. But if we see the spike in inflation start to come off, next year, that will be considered a temporary spike. And we're in the camp where we don't see commodity prices increasing yet again. We don't see shipping costs increasing by these amounts yet again. So we think as they plateau off, that inflationary pulse starts to ease. So, this time next year, we're expecting inflation to be running around 4% rather than the 6, 7, 8% rates that we're seeing globally at the moment. That's still high. That's still above most central banks' mandates. So there will be that conflicting force of we've got inflation, which is still a problem. We need to hike rates, but also looking at economies that would have slowed, I think, quite a bit since then. So I think we'll find ourselves in a position where central banks will probably start to pause, this time next year and have a look around to see how well the economies are actually handling that tightening that's going to be delivered this year.
So would that suggest to me, being a markets person, that given, say, the local interest rate market is pricing a much more aggressive track than the RB at the moment, that really there's potential for that to be unwound quite quickly.
Yeah, so when the RB delivered a 50 basis point move, 4 weeks ago, whatever it was, we actually saw financial markets rally or bond markets, I should say, rally, and interest rates actually fell a little bit. And the reason why they fell a little bit was because the market, as you point out, has got so much priced in. And there's a 4% terminal rate priced in to the curve, whereas the RBNZ is telling us it's more around 3.25 as to where they think they're going to have to go. So there's still this decent chunk of yield that can be stripped out of the market, I believe. So if anything, I would expect the Kiwi curve to steepen a little bit from here. So again, in May, the 25th of May, I believe they'll do a 50 basis point move, but their OCR track, I think, will only be lifted a small amount, probably to 3.5. And then again, you've got the financial markets looking at itself going, do we need this 4% terminal or should it be around 3.5? And I think you'll see another 10, 15 basis point rally or lowering in interest rates on that decision. But the long end of our curve, I think, will continue to be guided by the US and other markets around the world, and I think continue to creep higher.
In terms of the ability of households to kind of handle these increases, where do you think that's heading? And obviously unemployment is extremely low at the moment. I think it's 3.2 is the current reading.
Yeah.
It can't go much lower than that, I would have thought. How is this going to flow through as rates increase and businesses have to reevaluate whether they're turning a profit and where they can and find some capacity?
Yeah, that's probably the big question for this year. That's what we'll be keeping an eye on. In theory, all of our mortgage holders have been tested on rates, around 6.5%, which means that they should, in theory, be able to handle the mortgage rates that they're now rolling off onto. But that's all great in theory. You tell a household who's currently paying 2.5%, 3%, they're now paying 5%. You've been tested for this. Yeah, great, but I was paying 3%, now I'm paying 5%. That eats into my discretionary spending. So there's definitely, without a doubt, and as we mentioned before, with 70% of the mortgage market rolling over this year, there's no doubt it's going to have an impact on household consumption and overall growth this year.
Do you get a sense of what, I suppose the average is probably the wrong word, but sort of I'll use the word average mortgage size, because, using your example of 3 to 5%, on $1 million mortgage, that means somebody's got to find $20,000 after tax, which is not an insignificant sum. Do you get a sense of what the magnitude would be on average, or?
Oh, it's different for each bank, and I'm not sure what it would be across the entire economy, but I would imagine it would be around 400 to 500, and that sounds quite low, but don't forget there's a lot of people that have had their mortgages for 10, 15, 20 years already that are sitting on our books with not much left to pay. So it's always easy to focus on the people who've only just gone in and gotten mortgages for $1 million. But the back book is obviously larger and been in it for a lot longer. So yeah, I would say around that 400 or 500 mark at an absolute guess. Yeah, and there are a third of Kiwis who don't have a mortgage.
That's right. Changing tack for a moment. A lot of businesses, obviously, in New Zealand are sort of in the primary sector. Farms, Fonterra is obviously heavily involved, and they're benefiting from, I guess, the ability to pass on prices at one level as inflation goes up. And do you see there being earning surprises coming through that haven't been expected as a broader negativity flows through, but at the same time, a big chunk of the economy operates on the other side of the spectrum?
Yeah, we're sitting here with a record terms of trade. So our export prices relative to our import prices have never been so good. So from a very simplistic, looking back at the economy and thinking about how we're performing as a commodity producing nation, we've never had it so good. And we've got data going back to the 1860s. So, our commodity prices are very high. A lot of that's factored in. I'm not a commodity strategist, but from what I can see, there's some big payouts being announced by the likes of Fonterra. A record payout there, potentially more to come. And our other commodities, the prices that we're getting are very high. So yeah, I would imagine there's more upside risk than downside risk. But again, there are a lot of other factors around supply, like weather, and other factors that may have issues. Also, the cost of fertilizer and other problems mean that the costs involved in production is a lot higher. But yeah, I would be of the camp that I think there's more upside risk than downside risk. For what you mentioned earlier, Aussie commodity prices are rising. So are ours. It's a very buoyant situation at the moment.
Yeah, it's one thing that struck me as quite surprising, because I know ours is strong, but Australia's kind of off the dial strong. So
yeah,
really a major boost. Although, is it fair to say that this time's quite different from the last commodity boom in the sense that a lot of that infrastructure is already in place in Australia? So in some respects, it potentially may not flow back to the Australian economy that much. It may tend to move more to shareholders of the mining companies this time around.
Yeah, I definitely agree. There's unlikely to be a whole series of Gorgon type projects coming through like they were in the last mining boom. The last mining boom was absolutely incredible. Absolutely incredible. The hundreds of billions of dollars that was spent on LNG and other mines was phenomenal. I don't expect that to be done because, as you say, these projects have been completed. There's capacity there. It's more a matter of ramping up production than it is creating production. So, yeah, it is different. You're right. And they're going to reap the rewards of that mining boom that they've had.
I recall the number of engineering firms in Australia seemed to balloon. In the space of 2 years, we went from a few to very many, and obviously the ASX suddenly was full of them, which was quite an odd phenomenon for a while there. Just back to, I guess, within the New Zealand market, are there any areas you'd like to see the government spending more? Or do you think that they should be sort of tightening and supporting the RB's endeavours?
Oh, for me, I will keep banging the same drum that I've been banging for years. and that is we need more money spent on infrastructure. We've underinvested in infrastructure for decades. We have a great opportunity, I think, now to do more. It would be inflationary, but provided they are quality projects that get done, roading, rail, all the rest of it, we seem to shy away once it gets a little tough. We need to spend a lot more on infrastructure as a nation. Just almost like we've just got to take note and just get on with it. So yeah, I would be very disappointed if the government decides to scale back at all on the infrastructure spending. If anything, I believe that should be ramped up. And now that we've got a cooling housing market, I would hope that this time next year we'll be in a situation where the economy would have had a year's worth of falling house prices, a little bit below trend growth. The government will then take that as being a signal that yes, they can continue to ramp up infrastructure investment.
And the government's balance sheet, I guess, post-COVID is obviously not as good as it was pre-COVID, but relative to other countries, it's still looking pretty good, isn't it?
Oh, absolutely, absolutely. So we have a lot of debt in New Zealand. So we tend to focus on the private sector. We've got a lot of household debt. Yes, we do. We've got a lot of household debt, and there's not a lot of company debt. And obviously councils are up to their eyeballs in debt, which is a real problem. But the public sector, the government does not have a lot of debt at all. So leading into COVID, we had a net debt position of just 19.5% of GDP. That will blow out to 35%. Ignore the flip funding to the banks because that'll be paid back, so you don't have to take into account of that. And at 35%, we are still in the top 4 of AAA rated countries in terms of net debt position. So we're comparing ourselves to countries like Luxembourg, Singapore, and Switzerland, right? You can't find half these countries on a map, and we're in a better position than Australia. And when you compare us to other AAA rated nations, we've got a very low level of debt. And this compares to Australia, who's at 50%, the United States, who's heading to 100%, and Japan, who's on 260 odd percent of GDP. So we do still have a lot of capacity to increase debt, and I think we need to, because we've got to look at our economy as to how it's going to perform over the next 10 years. And we keep talking about productivity. Well, the one way to really boost productivity is through really positive investment, and that can be in education, but also through infrastructure. And we talk of multipliers. So for every dollar the government spends, what does it generate? The multipliers in investment in infrastructure in New Zealand is actually quite high. They're all over 2. So because we've underestimated for decades, we do actually get quite a decent return on investment from here.
Is one of the reasons we seem to be lagging in this front because of the election cycle, and the lag between when you invest and make a decision for the government, and then the next party comes in and puts the kibosh on your project. Do you see that as a problem, or because a lot of these projects take years to get off the ground and years to implement, and then your returns are somewhere into the future?
Yeah, I definitely think that's an issue, and whether you need to set up an external fund and say, right, we're just going to put money into you guys go and do the infrastructure investment, or whether you continue to fight year after year, 3 years after 3 years in these very short cycles. I do think that's a New Zealand and Australian problem.
The UK has an infrastructure fund, I believe, and we're trying to overcome exactly that problem where, the short-termism kicks in for political pragmatism, I guess.
Yeah, why do you think that, it seems like the debt story is something that's been very poorly told or sort of, hasn't really been sort of spread around the general community in that sense. Every time you sort of see spending, there's by definition the default article that says, well, they're getting into debt, that's too much debt. Why do you think the sort of government, and it's not just the current government, governments generically have been unwilling to sort of go down that path and say, look, our debt levels are way lower than the rest of the world. We've got opportunity and we can really make a difference.
Yeah, I think it's been built up over decades, and I think the fiscal responsibility act was a big part of it now, but we have been very conservative for decades on this front, and it's very easy to have a crack at your opposition by pointing to debt increasing. So again, it goes back to that point about some sort of infrastructure fund on the side that just gets funded would be a way around that. But that they're always going to test themselves, on economic management, and anyone who's increasing debt is seen as being a bad guy. Whereas that's not necessarily the case. I mean, you guys know better than anyone. Certain companies that take on debt to grow, to do what they need to do, it's so long as it's manageable and the ratios all work out, it's seen as a good thing, not for a government. And unfortunately, the government's to blame as well because their execution's not there.
Yeah,
and that's that's the biggest pushback I get from most people. I'll just say what I've just said, and they'll say, yeah, fine, increase the debt, but I don't think that money's going to be spent wisely. And I don't think the project's going to come through on time and on cost. And it's hard for me to argue with, the track record.
Well, the private sector also doesn't always nail it, to be fair as well.
No, that's true.
I mean, they've been experimenting with PPPs, and most of them seem to have come on over budget and behind schedule. So,
but again, you look around the world, and I think one of you touched on the UK, and I know the UK has a system where basically they take the budgeted plans and they actually run it through a series of models that look back and see how much things have been over budget historically and how much people, how over optimistic people tend to be, and rerun that through and come back with sort of more realistic numbers, and that seems to work quite well at a very separate level from where government is. Yeah.
Well, one listener's pointed out that we have the regional growth funds, and so I guess they're similar to the infrastructure fund. I don't know if you know a lot about them. I frankly don't, but I imagine that that was behind it was the same concept that we've been talking about.
Yeah, exactly right.
Pre-COVID, there was a lot of talk around capital adequacy and the Reserve Bank's expectations of banks. I guess looking forward and thinking what happens if property prices keep going up and then suddenly there's a shock to the system. And I guess arguably we're sort of going through that now, maybe not to the extent that they were worried about, but at least to an extent. Where is that sitting? And where is it sitting, I guess, from a bank perspective, from the bank, the banking industry, and also from the Reserve Bank's thinking? If they slowed it down, or have they still got it on the agenda?
Yeah, we're now required to hold more capital. There was a pause put in for COVID, but we're all ratcheting up the capital that we hold, and I think that would suffice for the RBNZ. We're at the sort of cutting edge, I think, globally. The amount of capital that our banks hold is higher than most. and we're ratcheting up as we speak. So yeah, I think in terms of what the Reserve Bank wants to get done, bank capital requirements would be in the basket of completion, and if anything's going to change, it's going to be around our lending, like debt to income ratios or other measures. So I think when they look at the banks, I think they'd be quite comfortable with the level of capital that we hold. So to make sure that the next downturn's not as bad, let's make sure that the banks aren't, lending too much, too high risk. So it would be more around LVRs and DTIs from here.
Okay. And I guess there's the other form of bank, which is the bank of mum and dad, and and that's obviously changed recently and is being relied on a lot more as the housing prices have run up. Do you see that shifting now? Willingness of family members to support people as the market cools for a period, and then I guess what does that mean from how the bank policy is put together?
Yeah, it's interesting, isn't it? It really has taken off over the last 5 years, this bank of mum and dad, and it's a sad event, right? It's from a society point of view, it's where are you born, what are you born into? Increases your chances of ownership compared to poorer families. So that, I think, really does just highlight the inequality that we have as a society. But in terms of the bank of mum and dad, we definitely see a lot of parental support for first home buyers. And I think if we just asked around ourselves, we'd probably know of quite a few mums and dads who are helping out their kids on the ladder. So it is a very real thing. You've got parents sitting there with a whole lot of equity, helping out their kids getting onto the ladder. How does that play out from here? I think it continues. Affordability in the housing market is only going to improve very slowly from here. Wages growth is going to pick up, and as you mentioned, we've got a very tight labour market, very, very low unemployment rate, so that side of things is improving. But that's compared to house prices, obviously struggling to keep up with inflation. And the supply demand of our housing market is going to improve, I think, dramatically over the next 3 years. So affordability will get better, but I don't think that it's going to stop or be enough to stop people asking their parents for help.
Yeah. And when you say that it's going to improve over the next 3 years, that's because of, I guess, the building activity predominantly, is it? Yeah,
exactly. We've gone through a really interesting experiment. We had a record migration boom leading up to 2019, so that was the largest migration boom in our history. Obviously, we didn't build enough over that period to keep up with the people who were coming in. Then now we've gone through a couple of years of net migration, around zero. It's given us a chance to catch up somewhat, and at a time when we've had building rates, I think, at the highest they've been since the 70s. So very high consent, a lot of work going on in the housing market, and the level of supply is actually outstripping demand at the moment because of the closed borders. So we are in a position where we've built up this massive shortage, and we're slowly eating away at it. And I think over the next 3 years, it'll be a much more balanced housing market.
But to reach, I guess, the goal of improving occupancy across the board, there's a bit of catch up to do, I imagine, and obviously it depends on what your target occupancy rate is, and I that's probably a political question rather than a economic one. Is what should ownership rates look like? Do you have a view of sort of the bands in which we should be looking to, and how long it would take to kind of get within that?
No, I don't. I don't really know on where we should be. Home ownership rates in Australia and New Zealand are very high compared to other nations already. But do we need to compare ourselves to Germany or with very low rates or other nations? It's good to have an idea, but it's part of our culture to want to own bricks and mortar. So a high rate for us might seem quite low to us, but very high by international standards. And so it should be if that's our culture, if that's the way we want to be. And like you say, it's going to take years of supply outstripping demand to better balance the housing market. And basically we want to be in a position where house prices fall 5-10% in the next year or so, and then stabilise. And stabilise, I mean, 2%, 3% growth in house prices thereafter. So therefore, your wages growth and other metrics can outstrip house prices, to keep affordability improving. But whether we can engineer that's another thing. But we're hoping that we're in a position where supply increases enough that over the next 5 years we get very, very subdued house price gains.
So that 5 to 10%, that's a nominal number, isn't it? So
yeah.
For a 3-year period, that might actually translate to a sort of a real decline of about 20% or something like that.
Yeah. Yep, exactly. So it'll be I think quite a slow downturn. It's not going to be a sharp, GFC style, oh my God, unemployment spiking to 8% type thing. It's going to be a very slow. This is now a buyer's market. You want to sell, you're going to have to hit the bid. Whereas the offer was clearly inflated. So I think that's the way it will play out over the next couple of years.
Yeah, I think one comment that struck me as being rather pertinent. Another economist many years ago said, when we were first talking about supply-demand imbalance, sort of said that the supply would act a bit like rust. And it happens slowly and you don't notice it, but over time it really becomes a big issue. And supply comes on that way and will balance it up. Yeah,
that's a really good way of putting it, right? That rust accumulated over a 10-year period, that undersupply. And, we got to a point there where, based on our modelling, there was at least 100,000 shortage. Over the last couple of years, that's been whittled down because of the migration story. But there's still, at least 60,000 shortage in our guesstimation, and that's the whole of the Hawke's Bay. It's not a small amount. So if we keep increasing supply, that rust will slowly get whittled away over the next few years.
Yeah, and a lot of activity needs to take place to do that. Right, there's a lot of building, a lot of pink bats, a lot of jib.
A lot of jib that no one can get hold of.
Yeah. So, which in a way portends, for the economy some good sides to it, right? Notwithstanding that rates are coming up and inflation's up, there's still a lot of demand and a lot of catch up to do.
Yeah, particularly in housing, exactly.
Yeah, fantastic. Mark, did you have any other questions?
The one last one I was going to ask was just you touched on currencies, the strength of the US dollar. Obviously, we've seen some very big moves, yen weakening. Very recently, Chinese yuan moving weaker. Do you have sort of, where is your view of the Kiwi? It's sort of been something which is not really on a lot of people's radars and hasn't been for some time.
Yeah, it's been very tough to forecast the Kiwi. It's always hard, but it's been particularly interesting. I thought the Kiwi would be stronger than what it is today. If I think back to last year, we had the RBNZ tightening ahead of others. We thought that the currency would be up around 73, 75 because we were the first central bank really to kick off. We didn't quite get there. We were in the 73, I think, range, and then obviously things declined. Now I think the reverse. Now that the Fed's going, I thought the Kiwi dollar would be falling more than it has. But then historically, as the Fed tightens, Kiwi dollar actually tends to perform quite well. So near term, Kiwi up or down, it's going to be tough. But I think by the end of the year, our forecast is 71 cents. So not a massive move and a whole lot of volatility around that. But one of appreciation as, we're in globally, we're still growing. It's still one where commodity prices are well supported, as you mentioned. And, we see a little bit of upside to the Kiwi. But that 71 forecast means that it could trade, 75, 65 in a reasonably tight range for the Kiwi.
Yeah, cool. All right, well, Jared, thank you for joining us. It's great to have you on the call and get your thoughts. And to everyone who's listening, have a great week. And we'll hopefully see you again, same time, same place next week.
Thanks all.
Thank you.
Thank you.